Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is Your Course to Retirement. Grand Rapids, your resource for a common sense approach to planning for our financial, our investment, and our retirement future, with guidance and perspective provided by Certified Financial Planner, CFP Ron Corser, the president and founder of Cornerstone Retirement Partners. Ron, always a pleasure to have you in.
Good morning, Peter, and good morning to everybody listening to today's program. Here we are, kind of the tail end of February. I'm not sure what the groundhog did or didn't do is of any importance to whether we're going to have more winter. I think just living in Michigan, trust me, we're not done with winter yet. So, just stay bundled warm and drive carefully. We're going to have a great discussion today about a lot of things on today's program. Now we're in the middle of tax season, and it's heavy on everybody's mind, and we're going to touch base on that. But one of the things that taxes bring up, and it's a cause for uncertainty at times, because we all sense what's going on in our economy and our country and everything, that taxes are going to change. And if they change, potentially, they're going to change by going up. And that's a concern. And some people are fearful of it. Some people are just concerned about it. Some people are wondering what to do about it. But as we all know, that's just one of the things going on around us in the economy, in our country, and in the world. We also have some interesting marketing things going on, and volatility has not gone away. In fact, market volatility is probably still going to be with us for the rest of the year, and maybe even going forward. That there's a lot of reasons for that, things that we understand. We do have an inflation problem in this country. We do have a supply chain problem in this country. We do have interesting government edicts and proposals and things that are impacting us. We do still have this COVID issue going around. So there's a lot of things that are coming, so to speak, to a point in time at the same time, and it's causing the water to start to boil, so to speak, a little more. But there's also some other things going on that have long-term implications, and it's something that as a firm trying to help our clients manage their money, their life savings, create income plans and things that we have to talk about. And the difficult part is, well, how do you talk about the future? Because as Yogi Berra said one time, making predictions about the future is really hard if you're thinking about the future. It's really difficult. But we know there's some things going on. A long time ago, I tell this story more and more now, back in 2006 and 7, I was part of the Harry Dent Network. Some people have heard of Harry Dent, some haven't. But he's a consultant, but he was also a guy who made some really interesting predictions about what was going to happen in the economies of Japan and our country. And back in the 80s, he predicted that Japan was going to have a major market correction and would go into a depression. And a lot of people said, well, that's insane, because back in the 80s, Japan was going to take over the world. The Japanese business model was so wonderful that we had to change everything. But he based his idea on a simple piece of data that says the Japanese culture is getting old. I mean, not kind of old. It was getting really old, meaning more and more old people as opposed to young people were in that culture. And he predicted, because when people get past the age of 55, they spend differently, that Japan would have a major market crack up. Everybody thought he was crazy. Well, guess what? In 1990, the Nikkei cracked up. It went from above 40,000 down to about 6,000. And really, the economy of Japan has never really truly recovered. They have massive debt. they have a population that's aging so fast you can hardly stand it, as they say. And probably by the year 2050, Harrington thinks, in my words, they'll become a fifth world country, simply because the population is growing so old, they're not replacing the old people with younger people, either through births or immigration. So he was right on that number. He was also right. I remember doing some things for our clients in 2007 that talked about the housing market. And back in 2006 and 7, he was predicting that the housing market was a bubble and that it would burst. And I remember a lot of people talking and a lot of people listening, and the people saying, you know what? The markets are going to go up forever. They're never going to burst. I mean, real estate is a limited commodity. It's always going to be there. Land is always going to be there. It's going to be a wonderful investment. And I even did some special client events talking about the Harry Dent model and his predictions and demographics and things. And one of the things he did predict is that we would have a market bubble in real estate and it would burst. And I remember having some people after that presentation come up to me and say, "You're out of your mind." And I said, "Well, I hope you're right." But as it turned out,
we had never seen anything like that in real estate previously.
No, not really. Even back in the Great Depression, it wasn't that bad. But as it turned out, 2008 was when the bubble burst, and it was a horrible experience. Well, he's issued another paper, if you will, white paper, that basically talks in essence that we have another bubble that's even bigger than the one in 2008. So bubbles have an interesting way of expanding like a balloon until they don't.
Until they pop. Yeah.
As an advisory firm, these are things we talk about with our clients, not to scare people, but to say, you know what? It's like winter's come in Michigan again, hasn't it? And we knew it was coming. A lot of us didn't like it. For me, every year, winter becomes just a little less wonderful, but it's coming. So I prepare for it every year. So if there's a bubble in real estate and you think about what the government's doing, think about raising interest rates, which will impact mortgages, which will impact a lot of things with all the market volatility, this could be a really adventuresome year. So one of the things we try to help our clients understand is what are some of the things that are down the road that may have an impact on their life savings. Now, we can't predict the future. I don't even try to. But as I tell people, I may have been born last at night, but it wasn't last night. We all sense that there's something going on that isn't quite right. And it's not something that we have to kind of hide out in a bunker for, but I think we need to be somewhat prepared for it or think about it. So those are some of the things that are coming on in this year that we'll talk about with clients. So anybody who's interested in having a conversation with us about their portfolio, about their retirement investments, about their income in retirement, and if what I've said maybe has piqued your interest, give us a call at 616-301-2581, 616-301-2581. We can help sort through some of these things and have a conversation about it so that there can be a certain level of understanding and maybe kind of think about what might we do? What's plan B? What's plan C? Because I can't predict the future. I just know that probably 10 years from now, things are going to be different than they are today. Just like today, things are much different than they were 10 years ago. And so the whole key is to understand a little more, have a lot of information in front of us so we can make great decisions. So again, if this is something, ladies and gentlemen, that you're interested in talking with us about, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com, and just put your information in there and we'll contact you and have a conversation. We'll share with you whatever we think we know, and you'll be in a position to make decisions or think about things going down the road that may help you. So that leads into today's conversation. It's just one of the things going on around us, and that's the idea of taxes. We're right up to our eyebrows and alligators, as they say, with tax season. People are wondering, do I have all my forms? Do I have everything done? I'm going to go take it to my tax person. I hope I get a refund. I don't want to pay. all those normal kinds of things. So we're going to touch on some of those today, and maybe touch on some things that you can still do that will help you. We can't do anything about last year, but we can certainly have some ideas available for you that may help you going forward in terms of taxation, what you're going to pay in taxes coming year, and what we might expect.
We are talking with Ron Corser, Certified Financial Planner, CFP, President and Founder of Cornerstone Retirement Partners. And we'll talk a little bit more about market volatility and uncertainty, and certainly dive a lot deeper into some of the things that you probably need or want to know about taxes and how to control your tax liability into the future, minimize that, be a little bit more efficient, keep more of your money is the bottom line and is the goal for most. So if you've got questions about that, if you would like to do some strategic planning around any of the topics on today's program, you're always welcome to give Cornerstone Retirement Partners a call, 616-301-2581. That is 616-301-2581. And Ron, I actually remember speaking with Harry Dent several times as he was making a lot of those predictions in the early 2000s. Working in radio, I did interviews with kind of well-known voices from all different walks of life. And from a financial perspective, he was definitely making waves. He was making some pretty crazy statements that drew a lot of attention. Now, back then, his prediction was that the Dow was going to hit 30,000 and then crash pretty precipitously. Now, the Dow during that period of time never hit 30,000. It did trend the direction that he was predicting, but never to the extremes. Well, here we are a decade and a half later, and the Dow has crossed 30,000. So maybe it wasn't completely wrong. Maybe it was just delayed 15 years. I say all that in saying that he's actually been out of the spotlight for quite some time, not making a whole lot of noise because people were saying, hey, his predictions never came true. And then until they did. But we can't control the market. And I know that you help your clients manage their assets and manage their investments in the market, but you cannot control the market. Instead, what you do is help them understand and control their exposure to the market and control how those dollars they choose to expose to the market are positioned to try to identify and capture some opportunity, but also to protect what's important. And those are the things that we can control. I've heard the expression here recently as people have looked at the volatility of the market that they've sort of been paralyzed, that they haven't known what to do, and so they just stand still. We don't need to have fear of the market. We need to be proactive on an ongoing basis, controlling what we can, which is how much we choose to expose to the market and for what purpose.
Yeah, ultimately, it even gets down to what we know in life. We can't control events around us, but we can control the amount of risk we take in our life. You know, I've talked about this before, as a young person, when I was living with my grandparents in a little coal mining town in Vittendale, Pennsylvania, gateway to Johnstown, Pennsylvania, place of the floods. We used to play a really dumb game, but it seemed like really cool at the time. We would try over a creek or frozen pond, see who could walk out the farthest without falling in. Now, when I look at that now in my life, I think, you know, that wasn't the brightest thing I could have done. But it was pretty cool if you got out to a certain point and for some reason you didn't fall in, but your friend did. That was not only funny, it was hilarious, and it was pretty good. But man, when you in the middle of winter, when you're up to your belt buckle in cold ice water because you went out too far, that's not a happy situation. So what can we control? We can control the amount of risk we take in our life by driving the speed limit, not driving 95 miles an hour. We can control the amount of risk that we take with our life savings if we're invested in the stock market by the investments we choose and the strategies we choose. We can protect our life savings from inflation as much as possible, given whatever kind of things we invest in. So we have some control. It's not as if we're helpless to events around us, and they don't have to paralyze us. And what we try to help our clients understand is that there are things we can do, given whatever's going on around us. that will either take advantage of something so we potentially can profit from it, or take advantage of what's going on to minimize or kind of avoid a catastrophic loss of any kind. So it's a nice balance. It's always a balancing act that we do, but we try to help our clients understand that. And I'm of the belief that a person or a client that understands more and has more access to information, the better off they are, the more sound the decision-making process will be for them. So ladies and gentlemen, if you'd like to talk about these things, if you want a little more clarity on what you own versus what's going on around you in terms of inflation, stock market volatility, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com, put your name, information in there, and either myself or our partner, Nolan, our managing partner, will contact you and we'll have a great conversation. And that's all we'll have unless you want to go forward with more. But the more information you have, the more you know, the better decisions you can make, not only take advantage of what may be coming down the road, but to perhaps protect yourself too about what may be coming down the road.
But volatile markets move. We know that they have moved. They will continue to move. And for savvy, informed, and prepared investors, even volatility creates opportunity. There is opportunity to be had. If we are nervous, if we are scared about the market, then that is an indicator that we have too much exposed to the market, or what we have may be inappropriately exposed to the market, or we may not have a full understanding of what we have. So we just need to sit down and review and assess that. And we have seen market volatility. We've seen people a little nervous here recently. We've heard a lot about that, and we understand, but there are solutions to approach that and have more confidence with your money moving forward. That's what the team from Cornerstone Retirement Partners do for their clients each and every day. And if you would like to sit down and have a thorough, comprehensive review and analysis of your investment portfolio, of your plan for your financial future, pick up the phone, give a call, get that written course to retirement plan put together, an assessment of your income, of your investments, of your taxes, of the healthcare solutions that you have in place, and of the legacy planning that you are doing. Those are major categories, lots more underneath that will be addressed in that course to retirement plan. Similar plans can easily go upward of $1,000 to several thousands of dollars, but Ron and his team from Cornerstone Retirement Partners make the offer to put that together with you, for you, on a complimentary, no cost, no obligation basis. So just call 616-301-2581, 616-301-2581, 616-301-2581. Ron, you brought along this list. It's a laundry list of all of these various tax forms and what they do, what they are for, what we need to know about them. I'm going to give you one in particular that I hear a lot of questions about, and that is the 1099-R. I'm going to give you two, actually. The second one is the 5498 form. And a lot of people have asked me about that 5498 form. Where is it, and when can I expect that one to show up? Can you talk a little bit about some of the various forms and maybe specifically hit on that 1099-R and that 5498?
Yeah, I can. I get the sense that we're playing that game. How far out on the ice can we go before we fall in? Because you get all these tax numbers, it's like, makes my head explode. So let's take two. And these two are really the ones we get the most call on. A Form 5498. What in the world is that? That's a form that the government requires from every company that holds IRA or tax deferred money for clients. The 5498 simply says on the 31st of December, for example, 2021, your IRA was worth X number of dollars. It will also tell you whether you need to take a required minimum distribution out of your IRA or not. Now, if you're under 72, you don't have to do it. So the 5498, I get this question, do I have to give it to my tax person? No, it's just something that says this is how much your IRA was valued at on the 31st of December. And if you need to take a required minimum distribution, we'll show you exactly how much that is for that specific account. So that's the 5498. The other one that is a tax document that you need to give to your tax preparer, if you use one, or you need to handle if you do your own taxes, is a 1099 letter R. That means if you got one of those, that means you took a distribution out of your IRA account that year. And that will tell you, do you have to pay tax? If it came out of a regular IRA, it is a taxable event. So that will tell you how much you have to claim. You add it into your tax return as income, the 1099-R. Now, if you take money out of a Roth account, that's also a distribution out of an IRA account, but it's not a taxable event. So you don't have to include that in your taxes. So this is a great question, because these are the questions I get most often. What's this 5498 thing? And what's the 1099-R thing? Now, the other 1099 doesn't have an R. It's just a regular 1099. That tells you if you have a taxable brokerage account, taxable mutual fund account, what have you. That tells you how much that account generated in taxable income, which includes interest, dividends, and capital gains. That's money that's in addition to your normal income and has to be included as part of your taxable income, depending on what kind of taxable income we're dealing with, capital gains, interest, things like that. But it's in addition to your overall income plan. So those are the three major documents that most people deal with when it comes to preparing their taxes.
There seems to be no lack of them. There are a lot of forms, the 1040, the 1040EZ form. If we've got a pretty simple situation, sometimes we can do it with that 1040EZ form. But if we've got estimated quarterly taxes, if we've got mortgage interest tax deduction, if we've had debt cancellation, if we have gifted anything for educational purposes to others, if we've made contributions or withdrawals from retirement accounts, there's a form for that, right? And if somebody
Government's got a form for everything we do. It doesn't matter what we do, they have a form for it. And trust me, if you can't find it and you need it, they will find it for you and come to your house. As my mom used to say, son, always pay your taxes. Because if you don't, she always would tell me, and it didn't make sense to me, J. Edgar Hoover is going to come to the house in the middle of the night and he's going to get you. I mean, she put the fear into me. Now, even at this late stage in my life, the memory, the mindset that I have of a grown man coming to my house in a tutu in the middle of the night is really scary. But that's what I have embedded in me. So my mom really, man, I pay more in tax than I have to every year because I don't want them coming.
It sounds like you somehow merged the tooth fairy with the tax man there. Right?
I know it. Yeah, it's a scary thing, like lions and tigers and bears. So the other thing we need to understand is we have until April 18th to file our taxes. You can always file for an extension, which gives you through the end of October, the middle of October, to finally do what you need to do to finalize it. But you have some time. Most people want to get it done as fast as they can because they want to know if they have to pay, if they're going to get money back, things like that. So let's talk about the idea of taxes. Most times, for most people, taxes are not an afterthought. We're always aware of them, but we deal with them in such a way, well, am I going to get money back or am I not going to get money back? This is a great time, ladies and gentlemen, as you're preparing taxes or having somebody do it for you, to think about the difference between what we call tax preparation versus tax planning. It's a critical difference, particularly if you answer the following question in the affirmative. Here's the question. Do you think over the next 1, 2, 5, or 10 years, what we pay in income tax is going to go up, stay the same, or be lower? If you answer that you think it's going to go up, This is a really important concept to grab onto, and that is tax preparation. Filing. All that means is you get all your stuff, put it in a brown paper bag, take it to your tax person and say, here, make it go, make it better. Tax planning, on the other hand, says, okay, let's talk about where I had to pay tax on, what kind of income, 1099-Rs, 1099s, things like that. Are there strategies available to me? Are there things I can do for this coming tax year, 2022, that can minimize the amount of money on a 1099-R or 1099 that I have to deal with to pay tax on going forward? And what I tell people, we do this, my wife and I, we meet with our tax preparer 3 times a year, and basically says, here's what's going on in our life. This is what we're thinking about doing. What's the tax implication? Because I want to know 2 things. I want to know what I think I'm going to have to pay in tax this coming year, all things being equal. And I want to know, is there something I can do to minimize that? Some way, somehow, either for this year or the coming years. So I always recommend, folks, it's hard for a tax person to do it maybe now, but certainly after tax season, it's worth paying them a few bucks. They'll love it. To say, look, I want you to do a proposed tax return for me for this year. This is what I'm thinking about doing. Extra income from different sources. What's the tax implication? Have them do that work for you so you can see it in black and white. And you can make great decisions then when you know, if I do this, I'm going to pay this much in tax. If I do this, I'm going to reduce my tax bill. It's a great thing to know. Tax filing versus tax preparation. I always vote for the preparation part. So if this is important, you'd like to know more about it, give us a call. 616-301-2581, 616-301-2581. Go to our website, www.cornerstone-rp.com, and we'll get in touch with you and help you out. We're not CPAs, we're not tax preparers, but we're able to help people with strategies in conjunction with their tax preparer or alone if they do their own taxes that we think can help them going forward down the road.
Again, 616-301-2581, 616-301-2581. And Ron and the team at Cornerstone Retirement Partners do have resources available to help with all aspects of planning, including that proactive tax guidance. And if I can paraphrase just a bit, Ron, this 13-page list of different forms that you brought along with you. Tax preparation is knowing which form you need and where it goes and what it does. Tax planning is helping us reduce the number of forms we're going to need into the future, so we can maybe eliminate a few of these taxes. So again, if you'd like to take that proactive approach, ladies and gentlemen, we're going to talk about some real strategic opportunities coming up in the next half of the program. But if you'd like that proactive guidance and assistance, pick up the phone, give Ron Corser and Cornerstone Retirement Partners a call. 616-301-2581, 616-301-2581. Quick break. We'll be right back with more with Ron Corser here on Your Course to Retirement.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
And welcome back to the program. This is Your Course to Retirement. Grand Rapids, your resource for a common sense approach to planning for your financial, your investment, your retirement future. The team from Cornerstone Retirement Partners. And with us today for guidance and perspective, we have certified financial planner, CFP, and founding partner, Ron Corser. We're talking about proactive tax planning, some tax opportunities, what we need to do as we are filing those taxes in order to control that liability, minimize it into the future. And if you've got any questions, if that is a goal of yours and you would like to plan strategically to achieve it, pick up the phone and give a call, 616-301-2581, 616-301-2581. Ron, before the break, we were talking about some of the resources that you have available here that can help people get answers, not only to their financial questions, but to their tax questions as well. Here's my tax question. Where do taxes go from here? What are we going to see moving forward and into the future? Some of it we may have some clarity and some level of certainty, and then some of it we might not, correct?
Yeah, here's the reality. If nothing happens in Washington, D.C., and I really get excited when nothing happens in Washington, D.C., that means they can't do anymore what they're trying to do. If nothing happens to the tax code on January 1, 2026, it's not too far away, is it? It's only about 3 years away. If nothing changes, the tax code that we have today goes away and it reverts back to where everything was in 2017. What does that mean? That means that when we talk about brackets, the 12% bracket goes to 15, the 22% bracket goes to 25, the 24% bracket goes to 28. So here's the thing that everybody kind of has to grab onto. If nothing changes, taxes are going to go up. If nothing changes, if they don't do a single thing in Washington, D.C. on the tax code, our taxes are potentially going to go up. So then a question becomes, what are we going to do? And the answer is, I don't know, but if you give us a call, we can help you create a strategy or strategies, ideas that will help you navigate what we know is going to happen, that if nothing changes in Washington, D.C., the tax rates are going to go up, which means we're all going to pay a little more in tax.
Ron,
So how do we navigate that?
The key to me would be taking advantage of these rates and these opportunities and the benefits that they present us before they end or before they sunset. And it would be first understanding where our current tax rate, our income, our bracket is, and then projecting forward and seeing if we are going to remain in that into the coming years, and especially during retirement. Because what you just said, the 22 becomes the 25. Well, there's a 24% bracket in between there. So technically right now there are two brackets that are going to be lower than where that income falls in just a few short years.
Yeah, it's something to be concerned about. A lot of times we only take a look at tax and say, what can we do today? But let's think this through. We talked earlier about a document called a 1099. Now that's the document that tells us in our taxable accounts, mutual fund accounts, brokerage accounts, what kind of potential tax income we have with interest, capital gains, dividends. But that can increase the amount of taxable income that we have to declare, which could increase our taxable brackets, which could increase what we pay. So one of the first things to understand this year is take a look, ladies and gentlemen, at if you had a taxable account, what is those little fundamental things called interest, dividends, and capital gains on the 1099? Generally in our industry, we call that phantom income because most of the time that's just increases to whatever fund accounts you have or your brokerage accounts that you pay income on, but you never really spend that money. So one of the things you can do is take a look this year and say, wow, do I have a lot of 1099 taxable income? If you do, is there some strategy or some idea out there that can help you minimize it? And there are. It just depends on your current situation. So one of the things we can help clients do is take a look at their 1099 income and say, well, here's some options for you to minimize the tax impact that it has, to perhaps reduce the amount of taxes that you'll pay on this kind of account. It can depend on the kind of investments you choose. Generally speaking, mutual funds can be a little more what we might call tax inefficient than, say, exchange traded funds. Those are subtle little differences, but we can help with that. We can also help saying if you put this money in this other particular account, you eliminate that for a while. So there are things that can happen that we can help people work for. Now, if any of this makes some sense or you want to talk more about it, give us a call, ladies and gentlemen, at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Just put your name in there and say, call me. I want to talk about creating some tax strategies or things to think about. we'd be more than happy to have that conversation with you at no charge. It's what we do. I absolutely believe that everybody has to pay their legal fair share taxes. I have never had somebody tell me what the fair share is. I think a lot of it depends on my fair share taxes is you pay more, Peter. That would be fair.
That does not seem fair to me, Ron.
But that's not how it works.
I heard Warren Buffett wants to pay more voluntarily. He should just opt to send them an extra check.
Yeah, he's not going to pay more voluntarily.
No,
He
he's
just
got a
lets
team of
everybody else pay.
accountants
Yeah.
that are paid so that he does not pay more.
Yeah. So these are things we need to talk about because they're going to become more important down the road. So what are some of the things that we can do? You can make more contributions to tax deferred kinds of accounts. Now let's think this through. There are only three buckets that you can put your money in, 3 buckets of money. One is a tax deferred bucket, a 401k, an IRA where you get a tax deferred benefit, but down the road, you have to pay tax when you take money out. There's a tax-free bucket, which can be a Roth account or a Roth 401k account. You put money in, you pay tax on the money going in, but you never pay any more tax. And the final account is a tax advantage account. It can be a taxable account that uses tax efficient investments. It can even be an account properly structured for some people, a life insurance contract. It's a great source of tax-free money down the road. So those are the only 3 kinds of buckets you can put your money in. And how you allocate your money determines ultimately, long-term, how much you're going to pay in tax. So let's take a look at another option here if we can. And it's one of my favorite options for those of you who are still working and you have access to a 401k Roth account. You can defer, if you have a 401k Roth account or 403b Roth, you can defer your employee part into that Roth tax-free account. Now, you won't get a tax deduction on that amount of money, but you'll put it into a tax-free account. Yes, you'll pay a little more in tax now, but down the road, you will end up having a tax-free account that'll never be taxed again. So that is one great option. And I always encourage people, if you don't know if you have a Roth account available in your 401k, talk to HR, find out, or call your custodian. They'll be able to tell you.
Go
You'll
ask.
pay a little more in tax now,
Yeah.
but you'll save a lot in tax down the road.
Ron, if we're talking about these changes that already are in law that we know are coming, even if we're in the 24% bracket today, even if that income falls in that 24% bracket, and we've enjoyed the tax deduction from the traditional 401k, if we switch those dollars to the Roth, effectively we'd be saving money if retirement is 3 or 4 or more years into the future, because those 24% dollars that we're paying tax on today would become potentially 25% dollars when we defer them into retirement.
Yeah, it's a good analogy. Here's how I try to help folks understand this. Let's say, and it's all based on your real tax rate anyhow, not brackets. And what's your real tax rate? That's the amount of federal tax you pay. And you divide that number by your adjusted gross income. So you may be in the 24 income tax bracket, but rarely is anybody really there with all their money.
Right.
So let me put it to you this way. Let's pretend that by putting money away in a tax deferred account, either in a 401k or an IRA, you say your real tax rate is 15% between the federal and the state. So you save 15 cents on every dollar you put in there. Now, let's say 3 years, 4 years from now, you want to take money out of that account. What if your real tax rate is 20%? So you save 15 cents going in. Now it costs you 20 cents to take it out. Here's the question. Was that a good decision? Was that a good deal? Most people say, no, that's not. So it gets down to, if we pay a little more tax today, we can put money in a 401k Roth that might be good. Or here's the other one that I want to talk about a lot, we do, is the Roth IRA account. It's one of the most overlooked savings vehicles available to us. What do I mean by that? You can put money into a Roth 401, a Roth IRA, even if you're involved in a 401k plan at work that has a Roth account. And here's the key, filing married jointly. If you have adjustable gross income under $204,000, you can put, if you're over 50, $7,000 a piece, a man and a woman, $14,000 collectively away into Roth IRA accounts. So what I try to encourage people to understand is you can have a Roth IRA account at the bank. If you want to keep your money in the bank because you're really comfortable with that, you have a great opportunity to take money that's earning zip for interest, put it into a Roth, and maybe that interest won't be taxable, but down the road, it's always going to be tax-free to you. So there's a lot of ways we can help people create tax advantage, tax-free account. So give us a call, ladies and gentlemen, 616-301-2581, 616-301-2581. We can help you with these strategies that'll make great sense for you now, but even more down the road.
And point to note here, Ron, is that banks oftentimes offer a little bit better interest on those kind of qualified retirement accounts where the savings or checking account may be 0.01%. They might offer us 0.5% on an IRA or a Roth style savings account. But if we've got money in excess of our emergency account, sitting around in checking or savings, earning a pretty low rate of interest, a low rate of return, these opportunities that you're talking about to get that money repurposed could be not only an advantage from the tax standpoint, but we could certainly simultaneously look at repositioning those dollars to improve the interest and the rate of return on the account as well.
Yeah, and the key, as long as you have taxable income, you can make a deposit Roth. You can. It's, ladies and gentlemen, it's one of the most overlooked investment options that we have, savings options. And everybody should take advantage of it, or at least look at it to see, does it make sense? Because actually Roth accounts are potentially more liquid, meaning it's easier to take money out of them than it is out of an IRA.
And you mentioned, Ron, that you can do this simultaneously with a 401k. Now, we've got to examine our individual situation to make sure all of this is applicable, but there is nothing that says just because you have a 401k, you can't do an IRA or a Roth or vice versa. You can do both of these simultaneously. And for a lot of folks who are kind of looking to supercharge that retirement savings, especially in the home stretch right before retirement, that could be a fantastic, yet unfortunately often overlooked opportunity.
It really is. It really is, particularly if going back a few minutes ago, we talked about if nothing changes, the tax code goes up like it was back in 2017. So we're automatically going to pay more in tax if nothing changes. So why not take a look at this as a potential part of your whole investment retirement income strategy? It makes great sense. A couple other things we can talk about. If for those of us who are getting up in age and you get to the point where after you're 72, you have to do that thing called required minimum distributions. That's just the government's way of saying, look, we let you sit on this money all your life, get a tax deferral. Now we need to take our piece back. So we're going to force you to take out money out of your IRA, even if you don't need it. Even if you don't need it, out of your 401k too, if you're not working, but you just left the money with the company. So what's that first time you got to take it out? It's 3.65% of whatever the total value of all your tax deferred accounts are if you're no longer working. And people say to me, well, I don't need the money. I wish I didn't take it out. Well, here's a potential solution that you maybe should look at. A lot of people have, they're givers. Got a lot of clients that are givers. They're not takers. And they want to do things. They tithe to the church. They give to certain charities. When you're 72 or older, what a great way to use your required minimum distribution by giving it to a charity of your choice, a qualified charity. And actually with a qualified charitable deduction, you can do up to $100,000 a year. What that simply means is if you're 72 or older, and you're tithing to your church. Instead of giving them extra tax money, give them your required minimum distribution or more. You don't claim it as income. It's not taxable to you. And the charity or the church gets the money. And as I tell people, I don't think the Lord Jesus cares if you get a tax deduction by giving to the church. I really don't think he cares. I think because he says we should be good stewards of our money, it probably is a better thing to do. But we can do it with a lot of other charities. Nancy and I give to several charities, and it's always an option for us. But we look to say, how do we make the best of what we want to give? How do we do that? And a charitable contribution, qualified charitable distribution is a great way to think about doing it going forward. So this is something we can talk about. More and more people are doing it. So give us a call at 616-301-2581, 616-301-2581. We can kind of explain how it works, given whatever accounts you want to use. It's always a good idea to give away something that you won't have to pay tax on than something you've already paid tax on. So give us a call, 616-301-2581. We are willing to show you how this works, and it'll help you.
Just kind of a side note and personal anecdote on that. I've had that conversation about giving, and my family, the conversation was, Peter, you know that God does not need the money. He's not asking you to tithe because he needs the money. It's all his anyway. He's asking that because it's good for you to be a giver. Yeah. To do that kind of giving is good for you and your soul. The church certainly is benefited by it, but God himself, Jesus the Lord, does not need the money, but it's good for you to be a giver. Anyway, that's just a side note there.
That's a great point.
Now, Ron, I want to back up just a moment here to talk about the implications of different types of income, because we hear a lot about active income versus passive income or investment income. And I want to note and clarify that when we take active income that we are earning and we put it into a qualified retirement account, such as a tax-deferred 401k or IRA, that does not then qualify it as passive income or investment income. That is still active income that we just have not paid the tax on yet. When we pull that money back out, it will be taxed just like brand new active income. And there are ways that we can, with money we've already paid tax on, with your 3 buckets, we can put that money to work, and effectively we've already paid tax on it once. We didn't spend it, and then we put it to work in investments, hoping that it would create little baby money and more bills for us. That can have some tax advantages, be classified a little bit differently as passive income, but that is not what we talk about when we're deferring taxes. We're just paying those taxes at a later date at rates that are, in many cases, yet to be decided.
Yeah, that's a great point, because at some point in time, the tax man cometh, and he never forgets about us. I mean, he's got a great memory. He's always waiting at the door, so to speak, waiting for money to come out of our accounts. But when we do start to actively manage or try to figure out how to manage the tax load, that becomes the key question of, okay, I have an account here that is going to generate a 1099. That means it's going to generate interest, capital gains, and dividends. How do I manage that? It's not something that we can just say, well, I don't have any control over that. You do have control over that. You can, you can buy a tax-free Michigan bond. It may not pay a lot of money, but it's going to be free if it's in the state of Michigan of federal, state, and local taxes. That could be important. You can use exchange traded funds, which are fundamentally more tax efficient and tax advantaged than, say, generally most of the mutual funds. So there are things that we can actually help you do when it comes to creating a tax plan for yourself that makes some sense. It's always a question of when. And it gets back to, I'm not a farmer. A long time ago, I had a chance to see a bunch of milk cows early in the morning do what milk cows do. And it was the most incredible experience of my life for a city kid. And that convinced me that farming was not going to be something that I wanted to do long term. But the farmers understand something really simple, is when it comes to paying, they can pay on the seed or they can pay on the harvest. So a lot of times when we're thinking about tax planning, a key idea to hold on to is, when am I going to pay this? Am I going to pay it on the seed or am I going to pay it on the harvest? You can do either. You can do what you want. But most of the farmers would choose to pay on the seed as opposed to the harvest, which means I'd rather pay a little bit now instead of a lot later when it comes to managing my investments, both in taxable accounts and in tax deferred accounts. It's a critical thing for us to do, because ultimately in retirement, and we've talked about this on the program, one of the two biggest expenses we're probably going to have in retirement, one is healthcare, the other is taxes. And taxes are just another expense like paying the gas bill, your Medicare premiums. It's just another expense in our life. And how we manage that expense determines the quality of life we'll have over time. We can always pay more. The government won't mind that, but it doesn't make any sense if you can avoid that. So give us a call, ladies and gentlemen, 616-301-2581, 616-301-2581.
Or you can visit online, cornerstone-rp.com, cornerstone-rp.com. And Ron, you had a few other opportunities that we wanted to cover. So just a couple minutes in the program, want to try to get through them as best we can. Now, if I am a saver, if I am looking for opportunities to make some contributions to fund retirement, if I ask my professional, what is the limit? What is the most that I can contribute to one of these Roth IRAs? I'm over 50 years old. They tell me it's $7,000, but they may be missing a few of the opportunities, because right now and until the April 18th, 2022 tax filing deadline, we can actually make a contribution for both last year, if we missed our opportunity there, and for this year. And for married couples, even if one of them is not working, actively earning income, we can make spousal contributions. We could theoretically do last year and this year for a spouse as well. So whatever that limit is, again, if I'm over $57,000, we could theoretically get 4 times that amount contributed to these Roth accounts or these retirement accounts over the next couple months.
Yeah, that's a great point. So let's think this through. If you're over 50 and you have the income to back it up, a married couple or a single person, doesn't matter. You can put in $7,000 as a 2021 contribution, and you can do that before tax season is over. And you can also put in 2022 another $7,000. So for a single person looking to jumpstart this, even if you're under 50, which means you can put 6,000 in, you can literally put 12 grand in, or a couple can put 14,000 a piece, or up to 28,000 right now. So this is an important way to save, ladies and gentlemen, kind of kickstart the retirement plan with, I'm never going to pay tax again on this money. Give us a call, 616-301-2581, 616-301-2581. We can help you set up these accounts. We can talk about how they work. We can talk about the things you can invest in, wide variety, all kinds of opportunities. If you want to be really safe, we can do that. If you want to go for the gusto, we can do that too. But it makes great sense to have this set aside now for your future. Call us at 616-301-2581 or go to our website, www.cornerstone-rp.com. Put your information in there and we will give you a call and help you.
And if you are looking to create a solid foundation for children or grandchildren, there are great ways that you could even get them started with their retirement progress with custodial retirement accounts for those children or grandchildren. And if we do see market volatility, which we started off this program trying to address some of what we've seen. But if we do see market volatility, that may be a strategic opportunity to do some tax control damage as well, and to pay less tax on our retirement savings. So look for those opportunities. Find out more about them by calling Cornerstone Retirement Partners. Give a call now for that Course to Retirement financial and retirement plan, a written plan for your financial future. 616-301-2581. That's 616-301-2581. Ron, we always appreciate the time, the guidance, and perspective that you provide here on the program.
Well, this has been fun. I enjoy talking about taxes, even though it's a kind of a bummer to talk about, but we have to. So, ladies and gentlemen, I hope you have a great Sunday. Take care, drive carefully. Bless you, and we look forward to hearing from you, talking with you next week.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the products featured